tax filing. So here it goes for mailing for corporate entities. How do we file tax and how do we make payment, and what are involved in filing taxes? If you are running a sole proprietor or you are running a small enterprise and GRA is on your neck to submit your self-assessment or tax filing, how do you go about it? How do you do it? Do you have people to help you in achieving this? Is it GRA helping you in filling this form, or you have a tax support or tax assistant person who is supporting you in filing this? What exactly goes into this tax filing? So the law is saying that since you are the owner and you know more of the affairs of your entity, you need to do an assessment or an estimation of the expected earnings that you are supposed to make in a year. So when you start a new year, you are supposed to do a form of a budget or forecast or something to be able to determine how much revenue, how much expenses you are going to incur. And if you strike it out, what profit are you going to make? If you are going to make an X profit, and your applicable tax rate is, let's say, 25%, you need to calculate that and also calculate the tax rate. This is what we call self-assessment. So you need to file these details and give it to GRA that this is the profit I'm expected to make in the year 2025. And out of that, I'll pay 25 of this X amount as taxes. And then based on that, you need to split it into 4 different quarters. So at the end of quarter 1, you need to file that amount and make payment of that amount, of the 1/4 of the amount to GRA. So if this is done well, you're able to meet the filing and the payment obligation as a taxpayer with GRA, and they will not come to you as being breaching their laws and come with other fines and penalties. That will also make your tax burden huge and higher. So if you're able to understand this, you can do it yourself, or with the help of an accountant or a tax person, you can draft this and then submit it to GRA to fulfill this requirement. So in fulfilling this self-assessment, what the statement of estimated tax payable should include this following. So it should include all your assessable income for a year of assessment. So if your financial year start from January to December, that's a 12-month period, it means that all the income sources that you earn as an entity, whether you have investment income, whether you are running a business, you are making profit, whether you are also an employee and you are earning employment income, you need to add all this, because all these constitute your assessable income, which should be taxed. And the chargeable income of a person is for a year, so it's for 12 months, whether it's January to December, or let's say it's this from June to July, that makes 12 months. So each entity has its own assessable year. And the estimated tax payable with respect to this income and any other form of income is what the Commissioner General requires you to submit. And in your estimation for this assessable income, you may need to consider if you have any other foreign taxes that you can claim credit for. If you have done any foreign transactions which you have paid taxes on, you can use it to reduce your tax liabilities as well. So a brief or a typical calculation of how the self-assessment is done. So we have a simple formula which we use in calculating your self-assessment. So we have here, the formula is into bracket A minus B, all divided by C. So what is A? A is your estimated tax payable. So after you have estimated your full year profit from all your income, and you have calculated a 25% on it, whatever you get becomes your estimated tax payable for the current year. And the B stands for any other taxes that you have paid in the year. So if assuming your estimated tax payable is 10,000 cedis for the year of 2025, if you spread this over 4 quarters, you have 2,500 for each quarter. So if at any point in time you have made any filed return and you have made any payment of a quarter, that represents your B. So if you take your 10,000, let's say less 2,500, then you divide it by a outstanding number of quarters. Do you have 3 quarters left to go, 2 quarters or whatever? Then that will give you your estimated tax assessment for any point in time. So this is just a way to show you how it's done. Maybe you might not know this, but this is what GRE uses in checking or ensuring that your self-assessment is filed accordingly. So I have an example here. A&B Limited estimated that its chargeable income for year 2023 is supposed to be 50,000 cedis, and its corporate tax is 25%. So how do you determine the installment amount to be paid in each quarter of 2023 year of assessment? Let's go through this example and see how the calculation or the formula is applied. So based on our formula of installment tax payable, A minus B over C. So our estimated tax payable will be 25% of the profit or assessable income of 50,000. So this will give you a tax liability of 12,500. Then B, which is the sum of all taxes paid in the year of assessment. So when you start from the first quarter, you haven't made any payment, so the taxes paid will be 0. And your outstanding number of quarters or quarterly installment will be 4. So you take 0 out of your 12,500 divided by 4. It means that for a full year tax liability of 12,500, you have to be making quarterly submissions and payment of 3,125 cedis to GRA as your self-assessment. So this is simple and straightforward, I think. Okay. So if you do that and you have submitted that to GRA, the law does not leave you there. The law also requires you that there may be instances where along the year, you estimate or you're able to have information to the effect that whatever you submitted as the quarterly self-assessment for self-assessment filing and payment might not be the same, maybe due to 1 or 2 reasons. Your expected revenue might drop or it might increase, and thereby you need to also adjust your self-assessment filing with GRA. This is necessary to do to reflect the changes. So how do we handle such revisions if there are instances like that? And I have an example here to also take us through. So ABC Limited estimated its chargeable income for year 2024 to be 50,000. The company faced serious challenges that resulted in decline in sales. The company then revised its estimated chargeable income to 40,000 cedis on 1st of August 2004. You are required to submit a revision of your installment payment of or for the 2 remaining quarters, because in August you may have filed for quarter 1 and 2 already, and you'll be left with September and December to file. So how do we go about this? Using our same formula, you calculate the 25% on your estimated income of 50,000 to get your estimated tax payable. And then your assessable or the sum of all taxes paid in the year is 0. Outstanding number of quarterly installment is 4. So this gives us the same quarterly amount of So 3,125. And then you have paid for 2 quarters already. So 3,125 by 2 will give you 6,250. So out of your 12,500, you've paid 50% of that 6,250 already. And now you have information to revise your assessable income or your self-assessment. So instead of 50,000, now you are expected to make a profit of 40,000. So your tax liability has now reduced to 10,000 when you multiply the 40,000 by 25%. And this becomes your new tax liability for the year 2024. But meanwhile, you have already made filing and payment of 6,250 for the first 2 quarters. So you subtract this from your 10,000 and divide it by 4. Then this will give you a new revised quarterly self-assessment tax liability of 1,875. So this is what you are required to pay in the remaining quarters, quarter 3 and 4 to GRA, since your income has been revised downwards. So this explains the revision where it goes down. When it goes up, it means that your remaining quarters payment should increase than what you have already paid. I hope you are good. Okay, so
yes, we are.
yeah.
But let me, just before you continue, team, if you have any questions, you can please drop your questions in the chat. Just
Yes,
so
you
don't lose your thoughts. Yeah. So we'll take your questions after that, but you can drop them in the chat section. Thank you.
Thank you. So under estimation of your income, so what does the law says here, or what does the Income Act, what is it saying here? So because what you submit as a self-assessment is based on estimation, and also along the year, you have the benefit of knowing or getting to know additional information that will inform you to revise your self-assessment. The law is saying that if whatever you file through your self-assessment for a full year, we compare it to your actual tax due or what you actually earn. So when the year ends, you truly know your profit for the year, and you have to apply the tax rate using the 25% on that to know what you are liable to pay to GRA. You need to compare that with what you have paid through the quarterly self-assessment. If you take 90% of your actual profit or your actual tax liability out of your actual profit, and you compare with what you have filed through the self-assessment, and you have any difference, and it's less than the 90%, it means that you have underpaid your tax liabilities. And there's a penalty for that. The law is going to penalize you for paying less than 90% of your actual. So it presupposes that, or it requires on business owners to make sure that as the years go by, or as you run through the quarters, you need to be looking at your numbers and make sure that what you are filing and what you are actually earning as the quarters go by, are you closer to that profit that you are filing through your self-assessment? If not, you need to send a revision to GRA with an explanation for that. Other than that, when the year ends and you make a filing of your actual profit and they compare with your self-assessment and it falls short of 90% of the actual liability, then there will be a penalty in place of that, which will not be, I don't think it will be to be good for you, because it's going to put more burden on your finances. You need to pay cash for that. So with this, I have some one example here to show. So the following financial data relates to SY affairs, and they are tax paid on self-assessment. So through their self-assessment, they've paid 100,000 cedis to GRA in 4 different quarters, and their chargeable income was 400,000. And when the year ends and they did their financial statement, finalized everything, audited it, they came to a chargeable income of 600,000, which is more than the 400,000 they have used in their self-assessment. So based on the actual returns, their correct tax payable should have been 150,000 for the full year. But through self-assessment, they only paid 100,000. So how much is the underpayment in terms of tax liability? And that is what the interest or the penalty will be charged on by GRA. So here, you, as explained, you calculate 90% of your actual tax liability, which now is 150,000 and not the 100,000. So the law is being fair. You say calculate 90%, not 100% of your actual tax, which gives you 135%. If you compare it with what you have paid through your self-assessment, you paid only 100,000. What is the difference? You have a difference of 35,000. So it means that you underpaid by 35,000 cedis for the assessable year in question. And this is the amount GRA will calculate and charge you penalty on that for the underpayment. So basically it means that we need to take the self-assessment and a bit cautious to make sure that we do not incur such penalties, because these are also add on to your tax liability that you pay. If you are not paying the right taxes, you are incurring additional penalties, and you need to pay such penalties, which the law does not require you to also deduct as a deductible expense. So the law bars you that any penalty that you pay by virtue of your negligence or not being able to verify the numbers, when you are calculating your profit, which will be taxed, you are not supposed to include. You need to exclude that expenditure in arriving at your taxable amount. So we need to take note of that and also reflect that in. So avoiding the penalty will be good than to have it and also not able to deduct it to reduce your taxable expense. But to end, we have a quote here which says that tax is not a punishment for the profit that you are making. It's just a signal that your business is alive and growing. So here our key lesson now is to learn how to manage it and not to fear taxation.